Well, welcome to our live Markets Happy Hour podcast in Singapore. So I call this model check because not only is, I think, Singapore perceived as a model economy in many ways, I think how we're obviously thinking a lot about the large language models as well. So we're checking in on that. But I would say what I've perceived about how Singapore is depicted outside on podcasts or media is a lot of discussion around how well you pay your politicians. You pay them enough that there's no insider trading or other activities, no conflicts of interest. And equally, there is a strong sense of that sense of duty around employees and job protection and a sort of a more managed process of moving to AI than simply a more sort of nakedly capitalist model that would suggest that jobs will be sacrificed. And then in terms of what we talk about every week, it's the same five lenses: inflation, interest rates, geopolitics, equity markets, and other asset classes. And in terms of sub-themes for this week, I will talk a bit about inflation's mixed bag, some quite divergent movements in inflation if we look around this region. And look at the war and ask whether investors are war weary, in the sense that they seem to be somewhat agnostic at this point as to the outcome. It just depends on the latest Truth Social post. This model check I mentioned before, I'd love to put it to you to do a regional vibe check to give me some insights there, and then just look at equity markets and how earnings have been digested and what we're seeing there in terms of the equity market valuations. So just to kick off with inflation, I will admit I don't know much about the Singapore inflation movements here and how you're experiencing price rises. But what we have been speaking about a lot is this in difficult nature of the last mile. As inflation makes its way down, how can it get to that final ultimate target of 2%? We've heard the Fed say that it has been misbehaving on the way down. And then I think there are some interesting global phenomena at work. The first chart here is showing Japan's inflation, which has already got core back below 2%, unlike prices in other developed markets. And this to me is very suggestive of how inflation can be sort of self-fulfilling in terms of expectations. Because Japan existed in this deflationary state for so long, now we look at how basically investors and market consumers are expecting prices to go down, so they aren't bidding it up. Whereas in developed markets, we might have the opposite effect, in that this is bringing forward of expenditure because they expect prices to be higher, perhaps when the real effect of the Strait of Hormuz closure is felt in markets. My daughter lives in Los Angeles, and there's already a kind of a family group chat concerned about the price of her gas there when it comes to $7 a gallon or whatever it may be. So it is taking its toll on the average consumer. We know it's high. Then the counter argument to all of this is that there is a fundamental deflationary force. This would be the opinion that David Kelly of JP Morgan shared on this podcast just 2 weeks ago, that overwhelmingly that the economies of the globe are biased towards disinflation, and that inflation is kind of a temporary phenomenon and will be ultimately washed out. I'd say just in terms of regional, clearly on the one hand we have Japan below 2%, but Vietnam at a 6-year high. So other more frontier markets, say, experiencing higher inflation. So I'd like to put it to you here on the ground in Singapore. Is inflation a topic? Is affordability a topic? Have Asian consumers just accepted that things are expensive, or any thoughts on that?
I live in Singapore for last 30 years, and I've seen through how Singapore have gone through the different phase of the price war and then inflation. And most recently, over the last couple of years, GST has gone up significantly in fact, originally it was 3% to 6% and then 8%, and currently it's 9%. And with this GST going up, many of these SMEs, F&B, and some of these companies, they actually take the chance to also increase the price. So with that, we have seen some of these prices have gone up more than 10 to 20%. Even for example, like now you go to a hawker center to buy food, for a meal, used to be just called $5 Sing dollar to get a meal, and currently have to be close to $10, almost double the price. If you get a drink, sometimes you have to $20. And I think that this is affecting Singaporeans as a whole, because I talked to many SME owners. They also find that currently it's very difficult to run business in Singapore. The labor cost has gone up, rental has gone up, and especially in running business in the last 18 months to 24 months has been very difficult. So many of them are struggling.
So not much of a deflationary bias then. It seems it's more of an inflationary bias more than that.
Yes.
And the good part with Singapore also is that the major components of cost like education and housing, the government controls it. So government provides housing. So I mean, Singapore is a very interesting market in the sense that you have a 60-40 locals versus foreigners, if I may call them, foreigner residents mix. And the locals are protected on the inflation side, on the housing and education, which are the two main components of inflation. Even then, people are feeling the heat on the consumer side, and in general, there's a feeling that the costs have gone up, but they're still on the local side protected.
In the US, we've spoken a lot about the K-shaped economy and the fact that it's persisted, it isn't getting easier, it's getting worse. The lower end of the spectrum does not really control spending. I think the top 10% controls 50% of the spending in the US. So when we look at the consumer, there's that massive, I suppose, divergence between the market sentiment and this Main Street sentiment. There seems to be a big, whereas markets look good, all-time highs, but on the other hand, we're feeling this pain. Is there the same sense of the K-shaped economy, inequality, concentration of wealth in the hands of a few? Is that really permeate throughout Asian markets or to different degrees?
Absolutely. I think most markets, you see that phenomena, markets like India, markets like, also you have to consider the fact that some of these markets are growing very fast and the wealth is concentrating in the hands of the top 5-10% of the individuals and families and businesses who are doing really well. And it takes time for that distribution of that wealth to the larger part of the economy. If you talk about India, for example, it's 1.4 billion people. We talk about 350 million middle class. But if you drill down further and you see how many of them have credit cards, how many of them have cars, and you put an income threshold, you pretty much whittle down to maybe 30 to 50 million people who are really, forming that middle class and spending. So it's very concentrated in many of the markets in Asia. I don't know Southeast Asia much, but feels similar for Indonesia or Vietnam.
Yes.
I think one of the big measures of whether people are suffering is homelessness, right?
Right.
In Singapore, literally, I'm not aware of any homeless people. If they are, they're looked after. Whereas you go to Hong Kong, you go to Australia, you go to LA, San Francisco, it's a disaster. I know it's getting worse, it has been. But inflation for me, my experience was living in Singapore, moving to Hong Kong, and big step up in rental. Well, this was back in 2010, and then coming back 12 years later, and the rents had sort of normalized. Part of that was because people from Hong Kong and Shanghai were getting out of those places during COVID, etc. But since then, there's more supply coming on, and I see less pressure on rents. Like landlords might be tempted to keep the rents high, but I don't think people are going to, go into those places as much as they were before. There's a lot of competition when we came in. I think you had a 5-minute appointment to go and look at an apartment, and it was like a queue. It was like a queue for a roller coaster, and none of the places I really liked. But I remember they were being bid above their asking price. And so we had to get really proactive. We got lucky, we found a place within 3 days just by being at the right place at the right time and making an offer and following through very quickly. But I think it was, if you were coming in at a peak time, like around the beginning of the school year, the rents were elevated. But if you were prepared to move in 3 months later, they dropped back down. So anyway, that was the biggest effect I've had. But since then, I haven't seen anything too dramatic. I think it's quite lining from my perspective.
It's important. The reason I asked about affordability is because one of the theses behind global diversification of an equity book is always the power of the Asian consumer or the rising Chinese consumer, say. The Singaporean consumer, I suppose, has arrived some time ago. But if this inflation pressure is continuing around imports, etc., and the labor is not keeping pace, well, maybe we have overestimated the power of the rise of that consumer. And as you mentioned, maybe it's a smaller influential group, but it's not widespread. And I think that is the narrative that gets distorted when we think about making the case for investing outside the US. Let me just go back to some of the other, and then we'll get to the vibe check. On inflation, obviously, food prices high, that's no surprise. Oil prices very much seem to be the barometer of sentiment around what's happening in the Strait of Hormuz. It was up to new highs there, even for the end of the year at a record, but they seem to have eased just recently. So that's been a positive movement. In terms of rate expectations, bit of a moving target here as well. This is the US focus. We know that when inflation was said to be misbehaving, there was a sense that rates were not coming down as we thought that they were going to perhaps stabilize. And we do have the case, I don't have a slide, but in the UK, gilts in the UK, I think at a 28-year high. So clearly a very unique situation there, whether that's reflecting lack of confidence in the government there, but certainly doesn't look like the Bank of England will be dropping its rates anytime soon. So this is the whole, what we've been getting to is whether stagflation is in fact something that needs to be combated, whether it's by policymakers or within a portfolio. I'm not sure how some of the other economic commentators are thinking about stagflation, whether in this part of the world or elsewhere, but it certainly has been popping up a lot in Europe, especially now that in Europe inflation seems to be rising again in Europe thanks to the current geopolitical areas. So I'll just move to equity markets to move things along. So where are we? Just in terms of risk, there seems to be this, I know that there's always been a very healthy risk appetite in this part of the world in terms of a hunger for yield and speculative investments even, and gold has been a theme in China. And we've definitely seen a very risk-on market within the US. I'd say that the surging in profits we've seen, partly it's due to profits, partly it's due to specific sectors such as software and AI, clearly. But just when we thought certain risks were off the table, as we can see with the tariff on autos in the EU, there's still that kind of a wild card always lurking out there around tariffs. And it's unclear as to whether markets really know how to cope with tariffs in terms of the implication for, say, European automakers. So the risks are still there, but I would say overwhelmingly a resilient market that is difficult to understand unless we bring it back to AI. And that really has been where the much of the work we've been doing has come to. This was some slides I had taken out of a presentation last week when I was asked to speak about something and about the famous Thursday when all the earnings came out. And the earnings had been so resoundingly positive when it came to Alphabet, to Amazon, to Microsoft and to Meta. 18% of the S&P between them, solid spending on certainly on CapEx, but cloud revenues up by double digits. An interesting slide I saw today was that a lot of the cloud revenue drive in all of these, certainly Amazon and Microsoft, has been driven by OpenAI and Anthropic. So their demand can constitute about 40% of the demand for forward-looking cloud revenue. So given that there is a lot of interconnected ownership stakes there, this does suggest that there is perhaps a double counting going on, or at least an excess concentration. And the narrative that is emerging time and time again when we think about the US, and I will talk in a little bit about US exceptionalism, is whether this is essentially a play on AI. And we've always been somewhat concerned about the concentration among, say, the top 10. But if we're looking at this level of this is just four stocks alone, 18%. And then the theme of AI is much, much broader than just those four stocks. So, and as I was saying earlier, I'm getting into these rabbit holes on X about this transforming labor, etc. Is there anything that could stop this vertical wall of demand, as it's been called by the CFO of OpenAI, or this momentum around CapEx, or how should investors play it? It's like, do they just stay in the stocks that they're in, or should they look elsewhere into some of the adjacent names? And I'm sure you have thoughts on AI, its sustainability, or whether this concentration is a concern. Looks like you want to say something there, Rob.
So I think there's obviously a big buzz or movement around AI and its influence across all our lives. I think at the moment now the question marks around the economics of it all are sort of coming to the fore. And whether that's, you know, on the revenue side relative to the money they're sort of raising, and I still think there's a lot of questions to be asked for investors on how that's going to affect their portfolios, not just directly in the stocks, but also, you know, other subsidiary auxiliary industries that are impacted by this. So I think, you know, the economic side of it on the underlying investments is an interesting thing to look at, which I don't think many people have been able to explain thus far.
Well, I mean, I didn't even read a headline about it, but I did read with interest about the OpenAI and Anthropic separately forming these consortia of private equity firms to invest in essentially consulting and integration. And this was a little bit of a theme we had earlier around just the mid-cap market, how that was poised to unlock its productivity and rise into sort of a second step versus these top names that they had not yet really had the advantage of AI even samples by them. It does seem a little bit strange that such an army and billions of dollars need to be spent on a product that should be so not so much self-explanatory, but self-evident that it is beneficial. If it's so self-evident, why do you need all these consultants to help you put it in place? Which again gets to this translation question, which we had. I've used the term last mile before with respect to the inflation, but there is a last mile of implementation with AI around vibe coding. Is that enough? So I think these are the cracks that perhaps have not been explored.
I've seen some of that myself, right? Because I'm in this new phase of changing careers, and I can get really good content, you know, 80% there, 90%, but it's that last 5% that's hard. I think you do need people to come in and be, you know, human soundboards maybe to help get over the line. Like I've turned this book that I wrote into 10 30-minute keynotes, and they're excellent. I sent them to a professional in the US. I said, normally I struggle with finding one good idea. You've got lots, and this is a good problem to have. But then I can repurpose that content into a retreat that I'm going to have in Japan. I can repurpose it into all these other little things. So if you're one person, it definitely makes you more productive, and the investment is a no-brainer. There's no way I'd be doing as much as I would be without it. But now you just got to do that at scale somehow.
Any other thoughts? I think that's a great point around the last mile and the one person. That's actually what Coinbase is now introducing, single person pods. But I mean, that's always existed in, say, a pod shop of a hedge fund. It's always had single star mentality with a little bit of a coterie around them. But so I don't know whether we're at the throw out the org chart stage yet. I think that's where I would question. And then as far as adjacencies, one of what we've been suggesting is that the adjacencies really get around things like following the money. If you follow the money from CapEx into the infrastructure, the data center spend, that's clearly been an obvious adjacency. Energy has been an obvious adjacency because that's we need more of that no matter where we are. And then equally the last part around the funding all of this is that they will run out of cash at some point with these massive CapEx spends. And therefore, they'll need financial structuring and financial advice from banks to get that next bond issue done or the next issuance done. So there clearly still needs to be a lot more focus on, I think, on the adjacencies, but a lot of scrutiny coming, I would hope, for the sector. In terms of I did have a thing up here about anti-meme. You just mentioned repurposing content. I was just reading about the clip economy. How that is now surpassed. If you look at the traditional media companies having had such a woeful spell, really since post-COVID, when in a sense they should have been doing well, that there has been nothing but kind of red ink there. And then this idea that the recent purchase by OpenAI of the tech chat podcast, much of that is around the monetization of their clips, not the long form content. So I suppose those of us in content generation, you know, where do we go from is the clip economy a fad that will come and go, or will we increasingly consume? How can we get much shorter than the TikTok style clip? I suppose that's my question: is that a flat line, or do we go back to long form? Clearly, a big theme of the US valuations have been earnings being so sustained, margins being protected. Some of that pricing power that you mentioned may be in place there. What is the margin picture like here in Asia, and the the earnings picture? Is it as robust as we're seeing here, or is it just like in Europe, fundamentally different?
Yeah, it's again like in many different economies, and it's different for each. And I guess China is coming back on the back of the latest, deep seeks and its prowess, autos, etc. India, for example, is also coming back. India did very well up to September 2024. Earnings were growing. We were getting upgrades, and India just started to accelerate before this Middle East crisis started. And then, unfortunately, of course, the oil price, being a net consumer, impacts India market as a whole. But we see the green shoots. We see earnings accelerating, being one of the few countries in the world growing GDP at 6-7%. But again, it's different for each country. And Singapore has been doing well on the back of semiconductor and electronics manufacturing as well. Surprisingly, a lot of people had concerns about the growth, but economy has been holding up well.
Yeah. I'd just like to end with some of these, what we're seeing in terms of the vibe checks here, because I'd love to get from you maybe other vibes you're hearing on the ground. So it's just a sort of going around a little circle here of what I've been reading. Clearly, I think my question is the US, and primarily the US, vastly underestimating the progress around AI, robotics, etc., that China is making? We know there's been a recent, they ran a robot marathon, I think, a humanoid marathon on the same day, but I did the Boston Marathon on the same day or same weekend. It was humbling indeed, but I didn't think that they were going to threaten the humans, especially now that the London, the 2-hour barrier has been breached. So that's one trend. Secondly, clearly Meta and Manus, there's a clear geopolitical implications of some of this data. Whether we mentioned already how proactive they are being around AI, and is that a lesson we should all be taking? And then whether Singapore will be the beneficiary of some of the private wealth, given that we're seeing some perhaps the Middle East not show the same promise, or at least some more geopolitical risk there. So is there what are we underestimating, I suppose? That might be a starting point in terms of some of the vibes here. Anything from the ground?
Well, what you alluded to in terms of China being very strong and have done a lot of work, invested a lot of resources on taking leadership both in auto manufacturing and also the talent, the homegrown talent on AI and everything around it. I mean, what's clear more and more now, looking at the last 2 years' developments, is US and China are strategic rivals, but at the same time, China will be a close second, if not first, in many of these areas. They have the resources, they have their 10, 20, 30-year plans that they've been working on. They're not starting today. They have been working on gaining leadership in these areas for the last decade or two. So it will not be a done deal that US will have leadership in AI or LLMs or chip manufacturing for a very, very long time.
I just want to add on to the point. I agree that in terms of the AI competition, US still a bit more in front compared to China. But one thing that US might have underestimated is for China's ability to copy. They are very excellent in copying technology, copying skills, and then from there they can scale it much faster because of their resources within China. Another advantage of China is that the cost of labor is cheap, the cost of material is cheap, and they have big population. So because of that, they have many use cases that can quicken a lot of implementations, especially AI required millions of customer base. They have that base within China itself. And I just give you one very simple example. I actually spoke to one professor in Shanghai. He was talking about how China advanced their healthcare over the last century and no, last decade. And how they do that is that first they copy from the West, right, US, Europe, and Japan market, and then from there some of the devices and as well as also the way to diagnose certain diseases, and then from there they applied it into the population. And for doctors in, let's say in Singapore, we only probably one doctor can see 100 patients in a year. For them, 1 month they can see hundreds of patients just in 1 month. Because of that, they can learn and develop new things much faster. And because of that, over the last decade, they just multiply the learning and multiply the efforts. And I think in the same way in EV cars, in AI, in the robotic, they have that kind of advantage, you know, with the database, population, the ability to replicate. They can put all the data scientists in one room, don't sleep for 3 days, 3 nights, and try to derive something out. You see the way they built hospitals during COVID in 1 week.
Yeah.
They have the kind of ability because of the grand size of the people and the resilience of the people they have. And I believe that is something that US might have underestimated.
Yeah.
And even if they're more advanced now, at some point China will catch up very fast because of this. Yeah.
That's a great point.
Yeah, I think one thing that people in the West tend to underestimate is the dynamism of the fiscal policy across the APAC region. When you're in London or New York, you think about, you know, Asia as a region similar to the Eurozone or the US, but throughout different economies in APAC, there are major economies going through vastly different stages of their economic cycle. So you have the ability to allocate at different points in cycles across different economies in APAC, which is, you know, advantageous. And the proactive fiscal policy, it's a little bit constrained now because we're out of a slightly elevated interest rate environment, but fiscal policy tends to be a lot more proactive here in different economies in different ways, which was sort of alluded to related to Singapore earlier.
Yeah, I'd like to just maybe separate from the US and China argument and, you know, Pan-Asia maybe as a whole, those are certainly going to be AI fighters or wars to pay attention to as winners for AI. But I think for our regions and maybe emerging Asia, so Indonesia, Vietnam, Thailand, Malaysia, Philippines, maybe even Singapore, the AI penetration at the corporate level is just very low. So if you're back to the conversation around decoupling earnings and the sensitivity to, you know, margins and capex and durability and that whole conversation, which is very real, we're just not looking at those types of businesses in this region. You know, we're talking very simplistic types of GDP growth in our regions. You know, 50% of GDP is driven by the consumer. So you're looking at, you know, digitization of financial services or ride hailing, food delivery, businesses that as US investors would all know from 10 or 15 years ago that work really well. So if you're looking for truly differentiated earnings and something different than the AI boom and having some more resilience in a portfolio, I think emerging Asia has a lot to offer.
Thank you so much for coming and sharing some of this on the ground insight with me. And we can certainly stay around and discuss, but I will we'll stop the recording there.